I gave you my numbers before. If you do, my number for the S&P is 10,000. My number for the Dow is 70,000. My number for the NASDAQ is 36,000. If you do the math on that, I did it before the meeting today just to kind of know where we're at because we've moved so much. I
Yeah.
think to those targets, the Dow, based on numbers this afternoon, the Dow was about 28% to that target. The S&P was 29, I think. The Nasdaq was 35, and I think the Russell was 32. My Russell target is 4,000. So that's we're basically looking at 30 to 40% upside from here, assuming my targets don't get raised again. And when I do the SMHs, semiconductor ETF, I use that as a proxy for the semi industry. I have an 800 target on that. And when I did the numbers on that, it's about, I think, 38% from today's price. So semis are a big part of that AI thing. That tells you I still think they have at least market performance from here, maybe a little better than market performance from here. The mags, I didn't do the numbers for the mags 7, but I think you're probably looking at pretty much in line market from here, but new highs. So the one area where I have put out, it's not an official target, but the IGV, the software ETF, I said several months ago when it went through its first sell off from its highs, I said I think it can get back to 110. And it got up to 108, a few months ago, and then sold off again, or a couple of months ago. And it looks to me like, and now it's 102 or thereabouts, that 110 still looks like a right shoulder on a head and shoulder top. If that's correct, it peaked, pre-Iran, I think. I don't remember exactly, but so its top was before. It had a left shoulder on the other side of that top, and I think we're forming a right shoulder at 110. Again, it can go to 112, 114, and still be a right shoulder. I think the top was up 116 or somewhere above that. If that is truly a head and shoulder top, software may not go to new highs. And, AI is part of that. AI's, Microsoft looks pretty good right now, so maybe that's not the case. We could go on to new highs. But if that head and shoulder holds, that is one group where we may not see new highs. But I think in most of AI, I think you're going to see new highs and another 30% plus. It's 30% plus from here, so I don't know how much above the highs that is on some of them. But Google and or Alphabet and Amazon and some of those, they still look fine. Apple looks okay despite the weakness this week. So I do think there's probably room there. On the other hand, they didn't ask this question, but when I do the numbers on my targets on things like the XLF, which is the financials, or the XLB, which is materials, you're looking at, in those cases, 50, 60% upside from here. So maybe double what you're getting out of tech now. So tech still has room to run here, but more like market performance from here or a little better. Whereas some of these things that are just coming up now that are, kind of the old economy or the more conservative stuff, some of those things are going to be the real outperformers in this final run.
What happens to volatility when the Fed goes silent at the top of the bubble?
Yeah, so here's what I've said, and I'll get around to answering that specifically, because probably my answer to that is I don't know, but what I have said is it almost, and that's where I was going before, and I lost my train of thought. I have said that whether it was Powell in that position, Warsh in that position, or anybody else, that when we go into a bust, their hand is going to be directed by the crash, by the bear market, and the bust is going to be so bad that no matter who they are and no matter what they say today, ultimately they would all be forced to do the same thing. So as much as I think there's a huge difference between Kevin Warsh's approach and Jay Powell's approach to monetary policy, in the end, that bust is going to trump all of that. And I'll explain that by saying, and I think I probably said this a year ago. I expect this global bust to be something worse than 2008-9, which means, and you're going to have a free falling financial system, not a bank or a company, but a financial system that's in free fall around the world. They are not going to be able to say, well, we don't believe we should follow the script we had in 2008-9. We think that was a mistake. We're not doing that again. They can say that on the way to that point, but once this system starts breaking, they're going to be deer in headlights and saying, well, we got to do whatever we got to do right now. We'll worry about that later. I believe, and this is just seat of the pants, but I believe we'll be looking at something like 20 trillion expansion in the balance sheet. So maybe more. So we were at 9 trillion. We were at 9 trillion in 21. Yeah, 2020, 21. We went from, I don't know, 3.7 or 4. We increased it 5 trillion. We backed it off. Now we're at about 6.7 trillion. I believe we'll be at 30 trillion in response to the bust. And that's just the Fed. Every central bank will be doing proportionally something similar. The money coming out of the system, coming into the system, will be unprecedented, to say the least. We did 3.7 over the course of several years post 2008-9. I'm talking about doing 20 trillion, just the Fed, and then maybe another 30 trillion from the other central banks. But before we get there, when we reach a top in the market and it starts rolling over, what's going to happen? Actually, 2008-9 is actually part of the problem because, and Warsh, maybe even more than Powell, but both of them have said they don't want to go back to that again. They don't want to go back to zero interest rate policy. They think that was a mistake, and it was. They don't want to go back to printing money like there's, QE infinity, like there's no tomorrow. So that means early on in a recession, early on in this bust, or on the way to the bust, they're going to say, yeah, we're not doing that again. We're going to go slow here. We'll cut rates a little bit. But we're not going to have the balance sheet zoom up. We're going to, maybe we need to put $1 trillion in, but we're not putting, 3, 4, or 5 trillion in. They'll look, and that won't put a dent in it. It'll keep going down. They'll come back and say, well, I guess we got to do a couple more trillion. But boy, we can't do much of this because we don't want to go back there again. And we got to remember to take this back out right away. And that won't do anything. In other words, the very fact that they don't want to repeat 2008-9's mistake, and they're cheered on by most of Wall Street, right? Most of Wall Street agrees that it shouldn't happen again. That means they're going to be slower to respond this time than they did then or than they did in 2020 by a long shot. That means many months probably before they get to a right-sized policy. So in answer to that question of, and this may have been a question from way back when, earlier in our interview, but when you have, AI companies going, looking like they're going to go under, or you have a bank looking like it's going to fail, how come, we know the Fed will just step right in? No, I think the Fed's going to be slow to respond. And it's that, when you're in this point of a cycle where things are really unwinding fast because of leverage, a month or two can be an eternity. So I'm not saying they're going to be a year late, but if they're late by a few months, you could have a much deeper decline and see many more failures than you would have seen if we hadn't had 2008-9. They're fighting the last war. They don't want to go back there because they got criticized so much for all that money printing back then and zero interest rate policy. But the problem is we have far more leverage today than we had then. We're going to likely have a faster unwind this time than we had then. And it's going to require bigger and faster responses when their inclination is to be slower and not responsive. You put that together, that's a big conflict.
So I mean, maybe I have this a little off. If your bust needs 20, 30 trillion of, my words, panic printing, Warsh built his career attacking exactly that. Why does the hard money man fold?
Because you have a choice, and that's why I say it will trump these guys. Because you have a situation where you're looking at it, and again, I'm theorizing as it'll come in some different flavor than I expect probably, but they're looking at this thing, and all of a sudden things are coming apart at the seams. Again, it's not going to all of a sudden happen one day. They're building up to it. They're responding to, problems in private credit, let's say, or problems in commercial real estate, or problems here or there. They're going to see some of this coming, but then all of a sudden it reaches a point where it starts really unwinding fast, or banks are starting to, almost. If you remember October of 2008. The critical point was when the commercial paper market froze, and the rumor around the street, I can remember this the day it happened, the rumor around the street was GE credit's about to go under, and so will GE. If you remember that, the policymakers responded quickly and opened up the commercial paper market. They stepped in, they went to, I may not have it exactly right, but I think that was when they went to we won't break a buck on the money market funds. And they stepped in all of a sudden and said, this is serious. We got to do all these things. And they held the markets together. If they hadn't done that, we would have had the bust then. The difference between then and now is this time I think we go over that cliff, because these guys are fighting that 2008 story. They don't want to do that again because of what the aftermath of that was. So that makes them more reluctant. But at some point, as we go over that cliff, they well know when that point comes, they're going to understand, if we don't do something today and tomorrow, we've lost the world's banking system. In other words, there's a domino effect going through the banks. And if we don't respond now, and the only way the reason why I know it'll be the Fed and the central banks, is fiscal policy doesn't fix something like that fast enough. The only thing that moves fast enough is to get liquidity in the system. And that's what will drive this, is the need for liquidity in a big way. And like I said, it'll start out with thinking, okay, $1 trillion might do it, or $2 trillion might do it, or $3 trillion might do it. Ultimately, each of those shovelfuls is not putting a dent in it, and it continues to get worse. They come in with both feet and say, okay, we just got to do whatever it takes. And then, and because inflation lags money printing by probably 18 months, there was a technician on Wall Street by the name of Stan Burge years ago, back when I was early in my career. He was at Tucker Anthony in Providence. I was at Textron in Providence. I went to lunch with him one time, and he brought out he was an engineer by training. He went into this because this was his love, but he was a technician. He brought out all his charts to show how inflation has an 18-month lag to money supply. And so you can print all the money you want. Let's say the bust hits second half of next year in a big way. You can print all the money you want in that second half of next year. You probably won't see the real inflationary effects of that until 2029. So, it might start picking up some the next year. But so they have the benefit of, you're in deflation, you're printing money, and there's no immediate inflation effect. So they're going to deal with the here and now. The emergency right now is the economy and the financial system. We'll worry about inflation later. The problem is, once it does hit the system, with that lag, it's going to hit fast, and you're going to go, in a matter of a few years, you're going to go from, low single digit inflation to high double digit inflation. So that by 2033, let's say, you could be looking at 25% inflation in this country.